Deflation is a terrible thing. Inflation you could tolerate.
You could trade anything as a trend fall.
When you think about Bitcoin, I don't think it's a currency. I think it's a commodity.
Today, we're in an everything bubble.
I'm Erik Schatzker, and welcome to Bloomberg's Front Row. Today, I'm talking to Steve Tananbaum, one of the best performing hedge fund managers of the past 20 years. Since 2000, when he founded GoldenTree Asset Management, Steve's flagship fund has returned almost 10% a year. And in 2021, it gained almost 22%. Steve hasn't just outperformed the stock market. He's done it investing in lower risk credit, from plain vanilla bonds and loans to the exotica of structured products and emerging markets. Now he's drafting a new playbook for a radically new environment.
What's kind of exciting is you're seeing a lot of fear, concern increasing about what the outcome is. Is this inflation going to be good for the economy or bad for the economy? Can the central banks actually raise rates?
Here's what Steve and I talk about: revaluations and the mispricings they create, distress 3.0, expanding into private credit, trading crypto, and the appeal of digital assets. Here's my conversation with Steve Tananbaum. Steve, the road ahead for financial markets for the foreseeable future looks a whole lot different than what's in the rearview mirror. How challenging do you anticipate this new environment is going to be?
Well, first there's volatility and unclear. So, and with that, with volatility, how are things priced relative to what the likely outcome is? And that's actually, what's kind of exciting is you're seeing a lot of fear, concern increasing about what the outcome is. Is this inflation going to be good for the economy or bad for the economy? Can the central banks actually raise rates? It started the year at 3 times. Right now, the market is 6, 7 times, could be 10 times. Can the economy withstand it? Can our national debt withstand it? So there's a lot going on here, which we think is going to make for an exciting environment. 2021 was a great year, but it wasn't a terribly volatile year. It was pretty much a strong tailwind, and now you're getting a lot of cross currents, and that's always makes things interesting and fun.
Let's pick apart inflation a little bit, because it's a new thing, right? The reality is that most investors have never seen inflation anywhere near this high, certainly not in the Western world.
Yep.
They're just not old enough.
Yep.
Is that a big deal?
I do think that that there is an uncertainty and a denial about what could happen. You even see it in this year with the number of hikes, the nature of inflation, whether it's transient. There was the transient camp, which is a shrinking, almost an extinct group, right now that is transient. So it's it'll be interesting to watch out.
Transient, transitory.
Yeah.
What do you think? Is inflation here to stay?
It certainly seems that way. I tend to be somewhat agnostic and look at the evidence, and the evidence seems to suggest that it's pretty broad. And when it's broad, it's going to be harder to extinguish. So we're taking that view. In terms of the so what, does that mean that they're going to continue to hike? Not necessarily. Does it mean that the dollar will appreciate or depreciate? Not necessarily. So there's so there's still a lot of unresolved variables out there.
The Federal Reserve is just starting to raise rates,
Yeah.
just starting to drain liquidity, right? Where do you think it stops and when?
The first thing is we are looking about what the effect on growth is. Is this positive or not positive for growth? If the economy is slowing, there's going to be a different response than if the economy continues to accelerate and employment continues to accelerate. And we need more information for that. So it's developing. In terms of how we're approaching, the duration of our portfolios is below average in our portfolios right now until we get more clarity. In terms of what the central banks will do, we think they're going to be kicking and screaming to raise. We don't see them getting out ahead of it. There may be some dissension on the Fed board, but we don't expect that. We expect them to be lagging, not leading. That's at least in the initial.
Lesson learned from maybe 2018?
Yeah. And just I think in general, it's really hard to get ahead of it, and until it's clear that it needs to be suffocated.
If low rates justified high equity valuations,
Yep.
and at the same time drove investors who wanted yield further and further out on the risk curve.
Yeah.
This is something that's played out over
Absolutely.
several years, but
Absolutely.
on an accelerated basis during the pandemic. Does all of that simply reverse now?
It seems that way, doesn't it? So it seemed as if the terminal value, if it's growing at one price and you have a lower discount rate, people seem to be overvaluing that and even being rewarded for it because the discount rate kept dropping. If you believe you're in a period of 1, 2, 3, 4 years where that might be reversing, shouldn't the discount rate be higher and higher? It seems that way. Now, there has been a pretty swift reaction already, where so the Nasdaq, et cetera, and a lot of the high growth companies, just look at FANG, have certainly been in more than correction territory. In terms of, so where does that leave the cyclical companies? And it depends what type of pricing power you have and what it means to your margins. And that's the bugaboo that I think isn't fully appreciated of the over-earning during the pandemic for certain industries and whether that's going to persist. No, it's still not. You see it in retail. That's a big question. Are you over-earning in retail?
Where else?
Are you over-earning in commodities? Are you over-earning in industrials? Is there really the demand there?
Tell me about the credit cycle. When did this one start?
Yep.
And where are we on that continuum?
If you look statistically, we should have a long cycle. But boy, it seems kind of different this time with a lot of variables, where you had much more stimulus than usual by a multiple, monetary and physical, and now that's being taken away. So we're in a very transitory time where we may get a hiccup, and even now the market is not necessarily pricing the probability of materially slower growth or of deteriorating credit, either through lower profit margins or because interest rates are higher, are still not priced into the market yet. So let me give you, Erik, another concern. Call it a year ago, the typical LBO would be 3 to 5% free cash flow. That was based on record profit margins and very low yields. More than half of the capital structures in these most recent LBOs are floating rate debt. Rate goes higher. If profit margins go lower, your margin of safety was pretty low. So we think there's going to be some volatility.
Expand on that for a little bit. Is that to say that the vintage of LBOs that we saw during the pandemic years, call it 2020 and 2021, are potentially set up for trouble or maybe even disaster in a rising rate environment with the possibility of a slowing economy?
If it turns out that it's a stutter step and you have stagflation, not good, because you have low margin of safety, and in terms of just free cash flow, you'll pretty much be free cash flow negative. And for a couple of years, most businesses don't maintain the same capital structure if they're free cash flow negative for a couple of years.
Are those the kinds of credits that you're looking at closely now?
We certainly are evaluating them. I mean, they're not. And by the way, most credits aren't free cash flow negative now, but in this environment, they could be. And the market certainly isn't pricing them as such.
One of your incredibly successful bets over the past few years was on restructurings among oil and gas producers and servicing companies. How much juice is left in that reorg trade?
You know what? We think there's a lot of juice left. And now, by the way, a lot of people have said that along the way in commodity markets, and particularly in oil and gas. In fact, if you'd be hard pressed to be looking at long biased oil and gas managers, who've done well over the last decade. It's like it's a very, they're not many of them. So
it's a short list.
Yes, if a list at all, but we still see great opportunity, and certainly, we think you're being compensated for what's on the table. So what do we mean by that? If we see the futures curve is suggesting oil should be in the 70s for the next 3 to 5 years, and you're seeing that. Let's just take in the commodity markets implying 55 to 60. That's a big margin of safety. We also believe that there's going to be increased consolidation. In the case of oil service, which are suppliers to this industry, we see this industry not only having increased utilization, but incredible synergies. And we've seen this with like a Noble, which is merging with Maersk. And if you look at the synergies, it's several $100 million. Then you put a multiple on that. That's just really, that's very compelling value that we see throughout the business or throughout the industry.
What are the next big themes that you're positioning for now?
So one of the things in 2022, we certainly didn't start the year this way, but when we've looked at the, I've been always, since college, checking the highs and lows every day. And I noticed that there were all these companies I didn't recognize. And that's like never happened, like the majority of companies I never heard of. And what I found was a lot of these are growth companies, cash flow negative, probably have gone public through SPAC, et cetera, in the last, call it 24 to 36 months. These are cash flow negative companies. In the Russell 3000, 20% are hitting new lows pretty much daily. And 2/3 of those are cash flow negative companies. That's a universe of companies that are going to need more funding, and the equity market isn't there for them. So we've been combing those and looking for opportunities.
What kinds of opportunities?
Good business models that need financing. We're looking for strong total return that would not be so rate sensitive. So we'd be looking at returns in the double digits in terms of rate to justify the risk that we're taking. But if they're good models, they're good business models like the, some of the ones like a Netflix, which use the high yield market to finance some of their losses, we think that there'll be some great opportunities. I think the crypto space, where there's a lot of financial innovation, is going to have some interesting opportunities on funding. That market, particularly on some of the growth rounds, got ahead of itself. And they're going to need to, some of the models make sense, but they're going to need capital that's in a different form than what they've been raising. You look at the private debt is continuing to gain market share. Banks who've been in the moving business, it's different than the end buyers of some of these large private debt firms who are in the storage business. And particularly when you're going to risk committee in a volatile environment, it may just be an easier conversation and not take for an issuer to not necessarily take flex risk and know what their cost of capital is, particularly if they think that they're buying a business at an attractive rate and the performance of the equity really is independent, whether they're paying 8 or 9% on the debt.
GoldenTree is one of the larger players in distressed credit, and your newest distressed fund, the one you raised in 2018, returned 40% last year.
Yep.
There's a recipe for success in distress today. You call it Distress 3.0.
Yes.
What's Distress 3.0?
So Distress 3.0 is using these distressed companies as platforms. And a platform is you're getting in at an attractive price, and then you're building it. And in order to have that, you have to have the right management team. You have to have an M&A capability. You have to have additional capital. This is basically just private equity where you're buying in at a lower rate. It's as simple as that. But that's different than 1.0, which was basically Philip Morris versus RJ or Nabisco. When I first got in the business, RJ or Nabisco was trading at a discount to Philip Morris. You could buy RJ or Nabisco debt at 4 times leverage at 15% yields. It was a food and tobacco company. Philip Morris, food and tobacco company, doing a little better operationally, but at 8 times, 9 times. And that seemed like a pretty good margin of safety.
So that's, almost ancient at this point. Distress 2.0 was what?
2.0, and 2.0 is still very evident, where you just have a weak management team, and they're not executing the strategy. But the difference between 1.0 and 2.0 is 1.0, you're just changing the capital structure. So it could be an IPO, which is what happened with Orgero and Nabisco. But you're basically arbitraging markets. And 2.0 is the execution's been very poor. And you basically need to change the management team. But once you get competent management team, if they do what they're supposed to, you're basically buying in at a cheap price relative to what the like companies trade for that are publicly, and then you exit. On 3.0, and that takes time. That's not instantaneous because they're doubters. And then 3.0 is basically 2.0 plus you're using it as a platform to build a better business and something that's more significant, and it takes longer.
But you need to have a much more direct role in creating that value.
It doesn't happen on its own.
The buzzword in credit for some time now has been complexity.
Yes.
The hairier the situation, right, the fewer the participants, and so in theory, the better the returns.
Yes.
Do you believe in complexity?
I think complexity is way overused in our industry. First thing is, all things being equal, I like simple. Simple to me, if simple and complex are priced the same, I'm for simple like every day of the week, every hour of the day. So you have to get overcompensated if you work harder. And for complexity, you have to work harder because there are fewer people who are going to go through looking at a situation. In addition, if you have tourists in the industry, all of a sudden if credit looks statistically cheap, they're not going to go to the complex situations. They're going to go to the easy situations. So what we found is complexity is only interesting if it's cheap in relationship to simplicity. And we very much pay attention to that. So like, for instance, in 2020, complexity, particularly after the pandemic, was quite attractive because you had motivated sellers and there were fewer people looking at it. So we bought a lot of complex situations. So what can complexity mean? It could be one-off financings of different divisions. It could be a very Byzantine capital structure where there's one box that's more interesting than another, like with Digicel, had a lot of different boxes. Or it could be like in Argentina, had a lot of different boxes. It could be like in LTs, had a lot of different boxes, to just give you a few capital structures that we were involved in. Then 21, low vol, complexity and simplicity didn't differentiate much. And that's where we actually sell complexity. Now, as volatility is picking up in 2022, we're much more involved in complex situations and pricing what the right discount is, or originating some deals that we think we might be overcompensated for the complexity.
Most of the great founder managers of your generation trained on a Wall Street prop trading desk, or perhaps a capital markets desk, or maybe under the tutelage, right, of a legendary investor. You came out of Mackay Shields, right?
Yes.
An insurance-owned asset manager.
Yes.
Was that a plus or a minus?
Well, I viewed it as it was. It occurred. I was always interested in investing. And the great thing about Mackay Shields, I certainly made it a plus for me. And when I was 25, I took over a $500 million fund. It was 89 out of 91. Within 3 years, it was number one, and ended up being pretty much number one until I left in February of 2000. People like Glenn Dubin of Highbridge approached me to run a hedge fund for them. I said, Glenn, why don't you just give me the money at Mackay Shields and I'll run it? And we did that in '96. So that was my first account. In fact, Glenn was my first account at GoldenTree. Met some great people, had investors like Steve Schwartzman along the way in the GoldenTree funds, and Pete Peterson. So it was it worked for me. But it certainly, I think you get different experiences when you work in at a prop desk than if you work for a mutual fund where there are flows in and out. And also what the mentality is of what mutual fund portfolio managers would do during times of volatility and how they react. So I picked up, for instance, what they're likely to sell, what they're likely to buy, what their first, so some of the trading strategies that worked well from a hedge fund were born out of running a mutual fund.
In the age of artificial intelligence, what changes for a credit investor?
We're still understanding the how it's going to be used, but it's going to, and that's developing here. But it certainly is going to make the mispricings shorter, particularly as macro funds are doing it. It's also going to, when you can isolate the variables that historically have worked and systematically analyze them, create very good profit opportunities, but still in developing.
Are you using it?
From a data standpoint, when we're covering companies, yes. On a trading, so in other words, when we're getting information on companies, we absolutely are using it. When we're trying to analyze data on credit stats or on sales stacks and retailing, et cetera. When we're looking at portfolio construction, it's not yet an active part of our portfolio.
How come? Not ready yet?
We haven't seen a tool that we think is usable, but it's not that we're not looking.
What's the one trade, or maybe two trades?
Yeah.
I'll give you two.
Okay.
You think of as GoldenTree's most successful ever, the investments that capture the essence of what you do differently, specially.
It's a great question. I'm thinking, probably, for instance, Puerto Rico, which was great, but it's one that has a lot of, we've had actually people outside here, so probably don't want to go there.
Well, it's not a secret. You're one of the few, creditors that made decent money on Puerto Rico.
Everybody did. They just don't talk about it. It's just being.
I'm talking about all time.
Yeah. No, I'm going on the billion-dollar trades.
Yes.
But UK Telecom was pretty close. The RMBS trade was a billion-dollar.
The pandemic dislocation.
Yeah. That was a billion-dollar trade. I'm just trying to think of just going in my head of the ones that I think. You know what? I'm going to actually do two in the pandemic. I'm going to give the RMBS. I'm not going to give the Digicel. And we probably, my guess is Digicel is shy of $1 billion, but more than $500 million. Yeah. So I'm going to give those two. Just listing it.
Steve, two of the biggest trends in credit, and they're overlapping, are retail funding and permanent capital.
Yes.
Blackstone, for example, is raising billions and billions of dollars of equity, the equivalent of a huge drawdown fund every quarter through its retail channel. Yeah. What's your thinking on retail funding and permanent capital?
We think permanent capital is great, and if you can justify and earn it, then it's less distraction for the manager. It's it's highly valued capital for the asset management firm. And in return, you should give differentiated returns. And if you could do that, it makes sense for both parties. And if you can't do that, then it's the asset manager 1 and the retail investor 0.
And is that why, I'll just put it bluntly, you're not doing what they're doing?
The one thing on retail investing is it can be expensive to set up. And expensive when you take all the channels and everyone who's getting paid, it can be expensive. So I think that time will tell whether the capital is justified. I do think that in general, in many industries, and credit is no different, you can't raise infinite capital and have differentiated returns. So, I would just, and that's not to, so I would just.
That's just math, right?
Well, I think
if you have billions coming in the door every month,
and
you have to do something with it, presumably invest it, that obliges you to put it to work, as opposed to perhaps being a little more patient?
Listen, I think it's very hard. One of the things, we don't necessarily want to poke holes at other people. I think it's tough, and time will tell. I think when you look at these BDCs or whatever, it's been tough for the people who've issued them in size. It's hasn't been the best experience, but I don't want to.
Sounds to me like you've looked at it and decided that's not something for GoldenTree.
We only want to do products we think that we can deliver differentiated returns. We've always been proud that we've done that. We'd only issue a product we felt we were able to do that.
Private credit is, to date, still a small part of your business. Depending on how you measure it, maybe
Sure.
5% or less. Why so little?
We've been seeing more competition for the deals that we would naturally do on the public side going to the private side. And we've participated in some of those already, and we expect to participate in more of those going forward. So it's more as the market's involved. We've always done private deals. It just wasn't of the velocity or the net or as a percentage of our assets as it's going to become. So we see it as a natural extension of what we already do. Part of it is because the market's actually more coming to us. What we used to do naturally wasn't done in the private markets, call it a $200 million second lien or type of financing, a $200 million EBITDA company that needs, the bottom 3 multiples or $600 million of debt now might be split between 2 private debt lenders, which previously was syndicated to 40 buyers,
Through a bank.
Through a bank. So it's a different, so that market's changed and we're changing with it.
What areas of private credit do you plan to focus on? And if you could look out, how big a business do you see yourself building?
Boy, we'd love to have this be a multi-billion-dollar, $5 billion plus product eventually. We don't see any reason why it can't be, and we believe that we'd be good at it as we've been with other credit products.
I want to talk to you about crypto.
Yes.
You're a believer in digital assets.
We are. We believe that the blockchain will be disruptive. We think that what's going on in crypto in the marketplace, there's a lot of financial innovation. We believe it's actually good innovation, which actually is going to be adopted and applied actually to places outside of crypto. And we believe that we're have a lot of resources. We're adding more resources to it. That there's going to be some great opportunities.
How does a credit guy, someone steeped in value and the importance of return of capital, make the leap to crypto?
There's going to be, we think, a lot of opportunity to have a loan at a discount or be involved in something where we believe that we can measure the downside and participate in the upside. And that's really what credit is. You're measuring the downside, participating in the upside. And we believe that being early in the space will be overcompensated for what we perceive the downside to be.
So you're not talking about buying tokens?
We may be given tokens as part of the compensation.
Right, but not making a directional bet, say, on token X, Y, or Z. Something different. Tell me a little bit more about the kind of business you see yourself building in the digital asset space.
Well, the first thing is there are many different options. So there's you take something like a Bitcoin and then the futures and how those are priced. You can get uncertain yields on that. So, and then you're really taking counterparty risk if you're fully hedged. So we've seen the relationship between Bitcoin and Ethereum be wide at certain points last summer, beginning of this year. But then there's also some bespoke opportunities. And it's something that, in terms of what GoldenTree does, it's really going to be trying to looking at trading opportunities versus maybe futures opportunities or options opportunities. Not so much directional. There might be other strategies that are more directional that we're adding some resources to, but that would be something that would be different than what our hedge fund would do or our distressed fund would do. We also believe that in crypto, you have companies that are going to be burning cash. They're going to need to, if they don't like the valuation of what they're going to get, they're going to need for alternative forms of financing. So, we may, that's going to be another option. There could also be something where we take a lot of tokens and with debt, where we think that the loan to value might be 10%. We'd like the upside, and we're getting these tokens as additional upside.
Do you see crypto credit becoming a thing?
The short answer is not in 5 years, but more likely in 10 years. As these business models are more mature, yes. But right now, they're just not developed enough.
What about the things already happening on the margin that look a little bit like credit, such as staking or yield farming?
Yeah, that absolutely is something that is something we'd want to be part of. And how we're going to be part of it, it's still developing, but we want to be knowledgeable and put in a lot of resources to look at what we think makes sense to us and to the issuer.
Does the lack of regulatory comfort with those businesses give you pause?
It's certainly something we are spending a lot of time on. We certainly are not calling the market ourselves without seeking counsel, that's for sure.
What about more personally?
Yeah.
Do I have it right that you and a few of your partners at GoldenTree were seed or early investors in Solana?
You know what? That's not true. Actually, Algorand, which was another large protocol.
Another token.
Yeah, another token. So Algorand was the one that we were involved in early, and many of us are still involved, and it's done very nicely.
How did you get there?
Great.
What's the bridge? It's just it's so interesting to me.
So, one of my partners, Joe Nagar, it was an area that he was very interested in. He got involved with the founder of. He went to MIT, so he knew the founder, and was on some subboards of MIT. But basically, he knew of Silvio, knew what he was doing, and is on his advisory board at inception and got us involved.
Do you see yourself getting more involved as a digital asset investor on a personal basis outside of what GoldenTree is doing?
I think it has it deserves a part of the portfolio, and so it has a part of my portfolio. It's not the majority of my portfolio or the largest part of financial assets of my portfolio, but it's a part that I think is a significant part. And we also believe that, or I also believe you're going to get, as you get more information, and as the industry matures, you're going to get more evidence about who the winners and losers are. It's still early on.
Of your own portfolio, as you just described it accounts for what percentage today?
A relatively modest, single digit, low single digits.
Okay. You're already going to raise a private credit fund. What about on the digital asset side? How long until GoldenTree raises a dedicated fund?
We hope not too long.
Okay. We're talking quarters, months, less?
We're hoping, it's, I would say a 22 phenomenon. It's, probably on the trading side first.
Okay. And when you do raise the fund, of what size?
We want to demonstrate that we're good at this, and usually the money follows, whether it's 100 million or more than that. But if we demonstrate that we can do well, I'm sure the money will follow.
So you're roughly speaking at about $50 billion today.
Yep.
If you're successful in private credit, if you're successful in digital assets, and if you're successful growing your existing products, where should you be a couple years from now?
We don't see any reason why we have on certain products like emerging market. They have terrific returns. It's a relatively modest product for us. The two portfolio managers have run much larger portfolios. We could see that being a $5 to $10 billion portfolio. So we see, when we put it together, if we continue to do well, we could see easily being $65 to $75 billion in the next 3 to 5 years.
Why have you not done what so many other founder-led firms did, which is sell a stake in your general partnership, creating liquidity
Yep.
And maybe optionality too.
So we recently last year raised $500 million at our holding company. This was
Of debt.
This was 3.14% interest only for 10 years. So we were able to raise this money, and we can invest in our products, invest in talent, can potentially buy a company or a division, invest in a lift out. That's all we need to grow our business. So would we ever monetize GoldenTree just for the money? Not something we're thinking at now. Would we do a transaction where we felt after the transaction we were a better company? Absolutely, but not just to monetize. We wouldn't be selling a stake, in the foreseeable future to just monetize part of the firm.
So you've thought about it, but there's no need.
Well, we actually were able to do something that we felt was better for us, which was I called it the cake, have our cake and eat it too. We got to keep 100% and then get capital to invest in the business.
You founded the firm. How
Yes.
much of the partnership do you currently have?
A minority, but a healthy amount, but a minority.
Like you, Glenn August built his firm, Oak Hill
Yes.
Advisors, into a credit powerhouse.
Yes.
Right? They manage about the same amount of money as you manage, maybe a hair more. Last year, he sold it to T. Rowe Price for $4.2 billion. When you saw that price, what thoughts crossed your mind?
I was happy for Glenn. That was my first 5 thoughts. We got unfinished business and to do, and we like being independent.
That struck me as a lot of money.
I think T. Roy wanted to use it as a platform, and so if you're, there is a interesting combination between their growth equity and their private credit that I think actually was kind of an interesting line. But I also think that they wanted to use it as a platform to increase their alternatives business. So from that perspective, I understood the price.
Have you ever had a conversation like that about selling GoldenTree?
We've been approached, but we are happy, independent, and having fun.
Steve, thank you so much.
Thanks, Eric.
Such a pleasure.
Thank you.